Hi, in this section, we are going to have a quick look at what do we mean by a protective put strategy. Now, first thing to know is that, for example, the protective put strategy is quite a popular strategy among traders who have long positions in stocks. So let's assume that you're a trader and you have a particular stock. Now, if you are holding a particular stock, you would ideally like the stock price to increase. If the stock price increases, you will make a profit, and what you don't want is, especially if you're holding a stock, is the stock price to drop. So let's assume that if your stock price drops for some reason, then you'll be making a loss, and of course any trader who has a long position will not want that. In other words, a trader would want the stock price to follow a bullish market. In other words, the price to increase. But of course, as you know, that you cannot predict the future stock price movements, and therefore one of the popular strategies that you can adapt is to purchase an insurance policy, which is a put strategy. In other words, you can buy a put option in the same stock, so it's as if you're holding an insurance policy that protects you from any losses. So let's see how that works. Now let's assume that the y-axis is the payoff and the x-axis is the stock price. So that's the stock price. Now of course, as you can imagine, the stock price would be a straight line. So for example, if your stock price is 0, of course your payoff is 0. And if your stock price is, let's assume you're somewhere here, so your stock price is $20, which means that if your stock price moves about $20 over time, you will make a profit, and of course if it drops below 20, you will make a loss. Now of course, if you're a trader holding the stock position, you don't want the stock price to move down, you want it to move up. But of course you cannot predict the market expectations. You might have a view on the market. Of course your view will be the market will follow a bullish trend. In other words, it will move up, but of course you cannot predict. So in one of the ways to protect your losses is to purchase a put option, which will cost you. So because you need to pay the premium, so you can purchase a put option which has a strike price of 20, which we call it as at the money put option on the same stock, that will protect you from any movements. In other words, if the stock price moves below 20, the put option will protect you. So let's draw that. So remember, a put option gives you a positive payoff if your stock price is below your strike price. So remember that a put option gives you a positive payoff if your underlying is below the strike. And let's assume that's the reason for this small space is because of your premium. You'll be paying a small premium. So you can see that's your put option. So that's your put. So your put option gives a positive payoff if your stock price, so let's assume you're somewhere here. At the moment you're somewhere here. You're somewhere here. Now, if your stock price increases over time, of course you will not exercise this put option. You would have spent some money to purchase the put option, which is your premium. It's like an insurance policy, but you will not exercise this put option because your stock price is increasing. But if your stock price over time it falls down, probably you will not be worried, because you have a put option which has a strike price of $20. In other words, that you can always exercise this put option at maturity and you can recover your loss. So what this means is that the payoff for these two positions, the total payoff will be something like this. So let me draw the total payoff of the whole portfolio in a blue line. So assume that this is a straight line. Just assume that this is a straight line. So that's your effective payoff. In other words, assume that you're here. Now, if your stock price increases, then of course you'll have a positive payoff. In other words, the blue line is your net payoff. You'll have a positive payoff. But if your stock price reduces, in other words, it falls down below $20, you will not make a loss. Your loss is limited, or your cost is limited to just this premium. You can see, if your stock price goes down, your position will be flat because of this put option. Because of the put option, your position will be flat. So that's the protective put strategy. It protects you from incurring losses. Now, if you're a trader and you have a particular stock, and of course you have purchased a put option on that same stock, and at the money put option, in other words, remember, at the money means the strike price is equal to the underlying stock price. So in this case, you will buy a put option where the strike price is also $20. So that's called an at the money put option. Now, if you purchase a put option, and if your stock price is increasing until maturity, let's say up to 3 months, then you will not exercise the put option. So you will not exercise your put option. You will not exercise your put option because you don't have to exercise your put option, and the only cost will be the premium. It's like buying an insurance. But if your underlying starts dropping, what you should do is you should wait till the maturity. And then you can exercise your option. You can exercise your option. So these are the two strategies that you will be using based on what happens to your stock price. Now, one thing to remember is when you're exercising your option, you should wait till the maturity. Now, the reason being, for example, if you exercise at this time, let's assume that you're exercising somewhere here, and then if the stock further drops, then you're not covered. In other words, then in that sense, then you'll have to purchase another at the money put option. So of course, given that we are talking about European options, probably you will wait till the maturity of the option to exercise the option. So that's an important concept. So protective put strategies, in a nutshell, protective put strategy, in a nutshell, it protects you from making any losses if your stock price drops from your current position. So finally, remember, when we talk about the put call parity, we were talking about European options. So in this case, the protective put strategy relates to an European option. So you could use this formula, holding a put option, because remember, in the protective put strategy, you hold a long put option. That means you have purchased a put option. So holding a put option and a stock, remember here we are holding the stock. So holding a put option and a stock is equivalent to holding a call option plus the present value of the strike, as if you're holding an amount of money. This you can think of holding a particular amount of money. So the protective put strategy is similar to holding a call option in the same underlying stock with a amount of cash. It's the same results. So remember, a protective put strategy is used. Of course, to establish a protective put strategy, it will cost you some money because you need to purchase a put option, so you need to pay this premium. But the benefit of holding a protective put strategy is that it protects you from any downward movements in the underlying stock price. So if the stock price moves downwards, it protects you from making any losses. So if you have any questions, put it in the comment section, or if you have any suggestions. And on the next couple of videos, I will also talk about the principal protected notes and a covered call. Thank you.